Hi, my name is Mark White from MHR Analytics, and today we're going to be taking a look at balanced scorecarding. Now, balanced scorecarding has been around for quite a while, and recently it seems to be coming back into focus, mainly from the point of view that people are moving away from traditional FP&A, as in financial planning and analysis, more into an xP&A process, as in extended planning and analysis. And this has been touted by analysts such as Gartner and various other analysts out there, and also been adopted by many other software companies. Now, because we're looking at the extended analysis side of things, then suddenly we can start thinking, well, actually, does the balanced scorecard have a part to play here? So we'll do two things. Firstly, we'll have a look at the concepts of balanced scorecarding, and then we'll have a look at using IBM Planning Analytics as a way of modelling a balanced scorecard and see how that could be delivered. Okay, so let's first of all take a look at some of the history of the balanced scorecard. Now, as I mentioned earlier, it's been around for quite a while. It was invented by a couple of guys, Robert Kaplan and David Norton, probably back in the 1980s. And the book was a very popular, very successful business book that was available at the time. And it was all regarding not just measuring financial metrics, but also measuring metrics across the business to get a much more balanced view. And the idea being, if you get the non-financial metrics correct, then the financial benefits should start to follow. Now, I mentioned earlier that in recent times, Gartner have been talking about something called extended planning and analysis and going beyond FP&A into xP&A. And to be honest, we've always talked about this with our planning analytics implementations, because we always talk about integrated business planning. And that's really looking right the way across the business, not just in finance, but in sales, but in HR, and looking at integrating the whole planning process together. So again, it's nothing new. It's something that we've been doing for many, many years. It's just got a new name, and xP&A seems to be on trend at the moment. So what we're trying to really do is look at how you can take a holistic view of the business and maybe use a balanced scorecard to measure it. Now, the approach that they took within the balanced scorecard was to measure the overall performance of the company, was to break the business performance down into 4 key areas. And again, these are flexible. You can call these whatever you want, but these are the textbook areas of the business that were mentioned. So we're looking at the finance side, we're looking at customer focus side, we're looking at internal business processes, and we're looking at learning and growth. And they're all joined and they're all linked. So for instance, your financial metrics are not going to improve unless you do well in the customer side of things regarding sales. You're also going to save costs by improving your efficiencies and your business processes. And often to do those, what you've really got to do is invest in people. And really that flows right the way through the whole business. So the first thing that they suggested is to break the overall performance down into 4 key perspectives. Having done that, what you then need to do is define what are your objectives in each of those areas. So for instance, in finance, we're obviously looking at increasing revenue, we're looking at reducing costs, and therefore looking at improving our key financial ratios. And you can do, again, these are unique to you as a business. Obviously, different types of organizations and different vertical markets will have different objectives. And obviously those need to be tailored to fit the business that you're currently in. What we then need to do is for each of those objectives is work out what the metrics and the KPIs are that we need to measure to find out whether we're going to achieve those objectives. And as you can see, we've got some examples in here of what some of those KPIs are likely to be. So let's look at those in a little bit more detail. So the first one is, if we look at this financial one, we're looking at 3 things. Firstly is increasing the revenue. And then underneath, what we're looking at are the KPIs that we're going to use to measure that. Now, in this particular case, what we've said is to increase our revenue. We obviously want to sell more. We might want to increase our sales volumes and maybe increase our average order value. The problem is with these metrics is they're all in different units of measure. So we're talking in millions for revenue figures, units for volumes, and then the average order value is more to do with the prices of the products. And you can't really add these three numbers together to find out on average how you're performing. The second thing is, where do these fit in a performance range? So again, one of the things that you would want to do is for each metric express what is your low range and your high range. And obviously the closer you get to the top of the range, the better that metric is performing. So firstly, we've got to collect the values. We've also got to set the ranges. But again, to add these numbers up and get an average performance, what we also probably need to do is look at scoring them. And in the balanced scorecard, it's done in several ways. It could either be a ratio between 0 and 1, or it could be a score from 1 to 10, or it could be a percentage. And therefore, what we can do is, if we know what the low range is and the high range is, and we also know what the current value is, we can work out where on those scores our current value fits. So over there we can see we have some scores, and it could be that what we can do with those is average them out and look at the overall performance. But that isn't where the balance piece comes in, because the thing about the balance scorecard, it identifies the fact that some metrics are more important than others. So for instance, you might sell more product, but if you're selling the wrong product and the product which is of a lower value, then you're not going to hit your revenue targets. So selling more units is important, but not as important as the overall revenue figures. And the same could be said for your order values. If you look at what your average order value is, you could achieve that by increasing your unit prices. But if you increase your prices, you might not sell as many, and again, may not hit the overall value. So one of the things that the balanced scorecard always did was said, okay, we need to balance those metrics and weight them in importance. So in this particular case, what we can see is we're ascertaining a higher weighting to revenue than we do to volumes and to order values. And this importance means that we can now get weighted scores. And that is quite key, because otherwise, yes, you could be measuring things, but not measuring as importantly the more key metrics that you want to take a look at. So weighting is quite important. The other thing that's also quite important is identifying good and bad metrics. So for instance, in this case, we're looking at improving employee satisfaction. So we're looking at the HR side of the business. And what we can see here is if we increase training, then the more training an employee gets, the better that is. So that's a good score. But the more levers we get is bad. And therefore, high isn't good in the case of levers. Again, employee satisfaction, the higher the score we get on employee satisfaction, then that is a good metric. So not only do we need to weight them, but we need to understand whether a metric being high is good or bad, because that also is going to have an impact on the weighted scores. So that's the general concepts. We're talking about looking at the overall business. We're looking at the 4 perspectives of the business. We're setting objectives for each of those perspectives. And then we're working out what KPIs we need to measure, and then looking at how we calculate what's good and bad and what weighted scores likely to be. Now, with a traditional business intelligence tool, which is purely designed for reporting, it's very difficult to do a balanced scorecard, because the key thing is collecting the data. Now, in a lot of cases, you can collect the data by having a data warehouse and data marts, etc., that will feed the reports. But you still need to be able to set up things like, is a metric a good or a bad metric from a weighting point of view. You need to know what your weighting percentages are, and you need to define those. You also need to be able to set your ranges. So there's a lot of data input required into a scorecard. And of course, quite often, not every metric that you want to measure is stored in the data warehouse. There will be metrics that may just need to be input manually. So having an input capability into the model is really quite important. And that's really why IBM Planning Analytics is an ideal tool for this, because being a planning tool, we can have the ability to input that data and also do the complex modelling to ultimately deliver the actual scorecard itself. So I'll tell you what, let's take a look and see how it works. Okay, so here we are within IBM Planning Analytics, and what we can see is we have a variety of different applications that we use here. And again, this is sort of following on with the xP&A message, where not only are we looking at financial data, but we're looking at sales, we're looking at HR, we're looking right the way across the business at all of the things that we do within our organisation. Now, what we're going to do in a second is we're going to take a look at this balanced scorecard example that we talked about earlier. But it is worth mentioning that IBM have their own version of a balanced scorecard. It's called a metrics cube. It doesn't adhere 100% to the Kaplan and Norton methodology, but it does adopt some similar principles. And maybe we'll take a look at that in another video, because it might be that that's more suitable to your organisation than the full-blown balanced scorecard. But take a look here at the balanced scorecard itself. So let's open the application up and let's walk our way through it. So the first thing is the main balanced scorecard dimension. And this is where we actually define that we're looking at total company performance, that we're breaking that down into 4 perspectives, so financial, customer, etc. As you can see down here. Within each of these areas, we can see we've got the multiple objectives that we're trying to achieve. And then within each objective, what you can then see are the KPIs that we need to measure. Now, as I mentioned earlier, some of these could get auto-populated from finance, sales and HR cubes. Some of the others would need to be input manually because we don't have those stored, the data stored in any other data models. Now, of course, what we can do is we can right click here, we can insert any perspectives and objectives and KPIs that we want. And obviously we will build this dimension to fit the business and the things that you need to measure. The next thing that we might want to do is put some more settings on each of those metrics and scores. So in this particular case, there's a few things that we want to do. The first is to identify whether a high score is good or bad. So again, obviously with income, if it's a high number, it's good. Whereas with cost, if it's a high number, that's bad. So we can certainly work out, which is a good and which is a bad KPI. This is a very similar concept to doing analysis on variance for income and expense within a profit and loss statement, for instance. The next thing we can do is define the weighting for each of the metrics, which will work out how the score gets rolled up and calculated to give you the objective score. A couple of things that we've also got here is identifying who the owners are of each of these metrics. So we can assign owners to these so we know who's responsible for getting the data in. And what we could also do is put in some sort of description to explain what the metric is and where the data is likely to be coming from. And if there's any calculated metrics in there, we could also define how the calculation is done. So giving people the information they need to understand it. And as I say earlier, you can see that, it will tell us if these are going to be pulled in directly from a sales model or from a HR model or from a P&L model, for example. The next thing, having identified these, is to look at the ranges. And in this particular case, we've decided to set different ranges for each year. So prior year, current year, next year, we've got different ranges for each metric. This could go down to every month, for instance, if you want the ranges to change by month. But in this case, we've gone down to yearly ranges because we expect to say, okay, this is our revenue target for this year, this is our revenue target for next year, this is the revenue target for the year after. And obviously, we want those ranges to move as we grow the business. Moving forward. So again, this is part of the input things that we were talking about earlier, the ability to input these numbers into the model with our read-write planning tool. And then, of course, having set up the metrics and the KPIs, the next thing is actually inputting any manual scores. Now, I mentioned earlier that a lot of the metrics will come automatically from other models, but in those cases where that data isn't stored within any of our models, then we might want to input the data manually. So for instance, here we've got what the market revenue is for our product stream. So not our revenue numbers, but the revenue numbers for the market overall. And then from that, we can use that to compute market share. So things like that are the sort of things that we may want to enter into this ourselves. So again, and things like here, we can see customer satisfaction rating. That could be coming from a survey that we've done with our customers. And again, we might want to input the results of the survey manually into the model. So having set all of that up, what we now really want is for planning analytics to crunch the numbers and basically calculate our scorecard for us. And that's what we can see here. So again, we can see the balanced scorecard hierarchy down the side. We can see our perspectives, our objectives, and then our KPIs. And again, here we can see what the actual score is, what the ranges are, and the fact that high is good. And then there's a couple of little tricks that we can pull in here that will help us traffic light those scores. So obviously we can see our average selling price is right at the top of our range. So it's a very high score, which is green. Whereas what we can see here, our sales quantity is just under halfway between the low and the high range. So that's sitting in the amber area. But the other thing that we can do is identify trends. And what we're doing here is comparing last month's score with this month's score to see whether things are getting better or worse. Again, one more thing that's really useful here is the ability to add commentary to these metrics. So for instance, if a particular score is looking bad in a particular period, what we may want is the metric owner to put some sort of explanation in there as to why that's not working quite so well. So there you can start to see how the scorecard works. And as you can see here, looking right at the top, the overall performance of the business is running at 53%. And then within that, we can actually see where the problems start to lie as we drill into each of these metrics and see, is it an internal process problem, or is it to do with, in this particular case, it looks like it's learning and innovation that's bringing us down. And that's basically looks like we've got some sickness issues or some vacancy problems, stuff like that. So maybe that's the area we need to focus to try and get our total score up. Now, of course, that's just looking at 1 month, and we can pick the month at the top and see what another month looks like. Alternatively, we could try and look at all of our months at the same time and see how things are trending over time. So here, what we can see, if we look at our financial metrics, we can see that they're trending down. And obviously that's not great. We started at 71%, we're now down to 51%. So there is obviously, actually that's financial, there's financial. You can see that's trending down also. What you can also see on here, we've got period 5 coming into play. And what you can see down at the bottom is we do have some data in for period 5, but not all of it. In this particular case, these could be some of the metrics that have been input manually and not metrics that are being fed from the other models within planning analytics. So just really to show the automation side of things, let's very quickly go into financial analysis and reporting. And let's have a look at our traditional FP&A sort of side of the business. And in this particular case, what we might want to do is take a look at our profit and loss. And again, what we'll see is the reason we've got no financial metrics in our scorecard at the moment is because what we can find is we've only got the actuals loaded up to the end of period 4. We haven't got period 5's profit and loss and trial balance loaded yet. So I'll tell you what, let's load the trial balance for period 5. And this means that we can then start to do our financial reporting and our financial month end. But what we'll also see is if we go into our monthly balance scorecard and just refresh the scorecard, what we should find is metrics will start to populate. And this is the automation side of things. So by joining up the different models, we can see that as each part of the model is completed, the balance scorecard gets populated. And we could have repeated this by going into the sales application and loading the latest sales data so we can do sales analysis, but also populate the sales aspects of the balance scorecard as well. Obviously, we can chart this in any way that we want as well. And again, that's one of the beauties of IBM Planning Analytics, is it's got the full business intelligence charting capability. And again, it's up to us really to decide how we would like to represent this data graphically and see how that works. So lots of flexibility within there as well. So we'll wrap it up at that. That's sort of a bit of an introduction into balanced scorecarding and how you could deliver a balanced scorecard with IBM Planning Analytics. As I say, in another video, maybe we'll take a look at the IBM equivalent, the metrics cube, which adopts some of the same concepts to this, but doesn't follow the textbook approach of the balanced scorecard. It could be that that's more suitable to you as a business, but hopefully you found that useful. Obviously, if you want any more information, then contact us and we can have a chat to you about it and show you how we could help you deploy this across your business. So thanks very much and speak to you soon.